Hello and welcome to Fisher Investments, 3 Things You Need to Know This Week. This is a new weekly segment designed to help investors worldwide sift through the noise and across financial media and really understand what matters for markets. And here are the 3 things you need to know this week. First, what does December mean for stocks? December is here, and with it comes a big question. How do stocks really behave this time of year? Historically, December has been a solid month for US stocks, but does that mean we're guaranteed to see stocks move up this year? Not exactly. Trends like this really aren't crystal balls. That said, there are some fundamental reasons for investors to feel optimistic. For example, things like falling political uncertainty in the US and strong corporate earnings look like solid supports for stocks as we head towards the end of the year. And history shows that after a US election, stocks tend to do well no matter who wins. Markets just like knowing who's in charge. Next, record market highs. You may have noticed the US and global stocks hit record highs in recent weeks. For some investors, that raises a bit of a red flag. They worry that the market could maybe nosedive sometime soon. In our view, all-time highs aren't a reason to panic. Time and time again, history demonstrates that record highs are really just a part of any long-term market cycle. For example, if you invest when stocks are at record highs, your future returns, whether you look on a 3-month or 3-year basis, are usually about the same as if you'd invested on any regular day in the market. Market ups and downs happen during every bull market, and markets rise about 2/3 of the time. So new record highs aren't predictive of future market movement, and in our view, really shouldn't influence an investor's decision-making process. To learn more about our views on new market highs, you can hear from our founder, Ken Fisher, in the link in the description of this video. Finally, the US job market. This Friday, we got November US jobs report covering things like non-farm payrolls and the unemployment rate. Investor reactions to the job reports have been somewhat fickle this year. Weak reports have generally sparked recessionary concerns, while strong reports have brought inflation concerns. That can be very confusing, but the key takeaway here is it's not helpful to put too much weight in any single month's numbers. Yes, the job market has cooled compared to years like 2021 or 2022, but that's really just a return to more normalcy, not a warning sign. Monthly hiring has slowed, but has stayed positive. And the recent rise in unemployment is actually a function of more people entering the job market, not a lack of jobs. Plus, jobs data tends to lag what's happening in the economy, so it's not a great tool for predicting where stocks are headed next. That's all for this episode of 3 Things You Need to Know This Week. For more insights, catch our other series, This Week in Review, which is released every Friday, or visit fisherinvestments.com. Thank you for joining us, and don't forget to subscribe.